presentation session. Can an investor consistently beat the stock market? Simple question.
Yeah.
Just introducing myself real quick. So, my name is Thompson. I'm an executive officer with the Northern New Jersey chapter of Mensa, and I currently work as a business strategist for a global cloud services company. I'm also a former FP&A finance manager, head of an air transportation division. Also worked as a transfer pricing expert for a Fortune 100 company, as well as a senior economist with the Department of Treasury. So I know a little bit about economics and a little bit about finance. I also managed a small investment management firm, really dealing with, it's a hedging strategy, hedge fund, but more macro theme hedging strategy. So I'm not going to talk much about that, but just to give you an idea about the stock market and whether the aspects of it that can be beat. All right. Now, a little bit about me also. I attended a number of universities, most notably I went to Columbia University in New York. I earned multiple degrees in economics, graduate degrees in economics and finance. And I published a book, so it was kind of cool. I don't know why it's doing all that. But it was on athletics, academic performance. Right? In other words, geeking out a little bit. How would you measure athletic performance? So that was kind of a geeking out project of mine. But then I took it one step further and decided to rank the top 100 professional players in basketball. I'm currently working on a couple of other books. Don't ask me how I get the time, but I'm not even sure when I'll be able to finish them. That's enough about me. So let's go back to the question on hand. Can you beat the stock market? So I'm going to speak on 5 main themes. The first is, what are the odds of beating the market? Is it possible? The second one is, if you can, how would you apply the principle? And one such principle is called value investing. And then I get into your 2 main scope categories of investment philosophy. One, as I mentioned, value investing, fundamental analysis based value investing. The other one is trend investing. And so I'll speak to both of those and see how you would apply that. And then I answer a question that is currently on the top of many people's mind. Is the stock market currently overvalued? How would you know? What mechanisms would you utilize to find that out? And then, say it is, how would you protect your long-term investment? So let's go to the question on hand. And I'll ask the question to the room. Can you beat the stock market on a consistent basis? Yes or no?
Yes.
No.
Yes.
All right, how many say yes?
Yes.
Just raise your hands. We've got, okay. How many say no? Okay, quite interesting. So, I'm going to give you the classic economist response. Ever met an economist before? Beside this guy? All right, so here's the classic economist response. Everything is a yes and no.
That sounds like a definite.
So, and that is true. The answer is a classic yes and no from an economist's perspective. So here is the analysis to answer the question. In any given year, the odds of beating the stock market is 50%. How do you know that? Because the stock market is an average of the price movements of all the different stocks and all the different investors out there. And so based on an average, approximately 50% are above that average and 50% are below. So the odds of beating the stock market in any one year is 50%. By way of reference, last year the S&P 500 grew 23.3%. So that means approximately half of the investors did better than 23.3% and a half did worse. Make sense? Mm-hmm. But over the long term, the odds get incredibly lower. Why is that? This is now we're going into the basic math here. If the odds of beating it in year 1 is 50% and the odds of beating it in year 2 is 50%, then the odds of beating it in 2 straight years 50%. Is just 25%. Right? And the odds of beating it 3 straight years is 12.5%, 1 in 8. So it turns out, for you to beat the stock market 10 years in a row, it's approximately 1 in 1,000. That's difficult, but not impossible, 0.1%. Now, what are the odds of beating it 20 years in a row? It's 1 in 1,000,000. But now it gets even better. Can you beat the market 30 years in a row? The odds are 1 in 1,000,000,000 that can happen. Yet, there are people who have done it. And I will walk through one example and tell you how they do. So, can you beat the market? Yes, in the short run. Virtually no in the long run. So, I know you have a question. I'd like to hold some of it to the end, but if you've got something related to a particular topic, I can take it right now.
I was gonna say, isn't the object not to beat it 30 years in a row, but just beat it 16 out of?
Why is the object not to beat it every year? Who wants to be half as good if you can't be good all the time, right? So before I get into the question of how to beat the market, if it's possible, let's start first by answering some simple question. What is the stock market? It turns out it's not as simple an answer as people think. Yes.
So if it's, let's say it goes up 20% last year, that doesn't mean that half were higher than that and half were lower. Let's say people who, made more than that were 21, 22, 23%, and others lost a lot. That means that 90% of people could have had a higher return and
That is
10%
yes.
lower.
So that's why I said approximately a half, right? Truly, to get to the 50%, we would talk about the median. But that's a statistical term, and I didn't want to get into the median. But to your point, right, it's not exactly 50%, it's just approximately 50%. That gives us the half and half. Because some win big and some lose big, but it's the distribution that matters that gets to the 50.
But it's still actually less than that. Most people buy mutual funds and there's cost in the mutual funds.
Mhm.
So your up and down is
So-
further down.
So you're talking about the net return.
Yeah.
Yes, and we can get to that too, right? So we're looking at gross return in this case, right? But can you still beat it over time? The answer is still yes. But it takes a very special set of skill sets to do, right? So let's start first with what the stock market is, so we make sure we're all on the same page. So a stock market is where shares of a corporation are traded, right? Those shares are often called stocks or equities. So if your equity market or stock market means the same thing, you never talk about share market because the shares of the corporation are what are traded, and they're traded in blocks called stocks. Now, the most famous stock market or stock exchange is, of course, the New York Stock Exchange. But exchanges are not traded. So there's no way to buy the New York Stock Exchange, for example. So what investors do and investor groups do is they create indices that replicate the market. So you trade the indices, you're not trading the market, but the indices are an approximation of the market, right? The most famous indices we're aware of is the Dow Jones Industrial Average. My clicker doesn't point on this thing, so you can't see it, right? The Dow Jones Industrial Average, abbreviated DGIA. The second most popular is the Standard & Poor's or S&P 500. So they're the most widely known indices out there, but they're not equivalent, and here's why. If I were to ask you which indices is the best to track against or to compare your investments against or to trade against, a lot of people. Oh, thanks. Okay.
No, it's the screen itself. Doesn't reflect.
Yeah, the screen just doesn't. Yeah, so this is good. I appreciate that. Thank you. So many people track the Dow Jones Industrial Average. There are two reasons why the Dow Jones is not the best indices to track against. The first is that it's only a collection of 30 stocks. Yes, it's 30 of the largest stocks, not the 30 largest, but 30 of the largest. Just to give you an example, we'll talk about the Magnificent Seven stocks later on, Those are the 7 stocks that are technology stocks that have been performing the best over the past 2 years in particular. Only 4 of the magnificent 7 stocks are in the Dow Jones Industrial Average. 2 of them just got added last year, Nvidia and Amazon. So it's not a reflection of the top companies on the stock exchange, just 30 of the largest. At the end of 2024, the total value or the total market capitalization of the stocks in the Dow Jones Industrial Average was just $19.5 trillion. Now that's a lot of money, but that's only 30% of the total stock market value in 2024. So that the Dow Jones does not accurately reflect the stock market, however we define the stock market. That's one main reason why it's not the best indices to track against. Despite when you watch the news and they talk about the stock market, they always lead with that Dow Jones because it's the oldest. Doesn't mean it's the best.
It's also the highest number, and people.
It's the biggest number,
They turn on by that. They look at 30,000 or 50,000.
Right.
Wow, look at that.
Without understanding how it's compiled. It's just a divisor. You can divide by a bigger number, you get or whatever the case may be. Another reason why the DJI is not a great indices to look at is because all the other indices, and we'll talk about the other 2, they are market cap weighted. Now I'm not gonna get into statistics, I promise you. But if we talk about means and averages, you can do a simple average or a weighted average. These indices are weighted average. The best weighted average is to weight them according to the size of the companies, or what we call the market capitalization. The Dow Jones does not do that. It weights them by the price of the stocks. It's a price weighted indices, not a market cap weighted indices. So those are 2 reasons why it's not the best to compare against, and therefore the least representative of the overall stock market. It's just the oldest, which is why it's historically remained relevant. The second, which is the most widely traded, is the S&P 500. At the end of 2024, the S&P 500 total market capitalization was over $52 trillion, or 80% of the total stock market. That's the reason why it's the most widely known and the most widely traded, I should say, because it's the most representative. It has almost the 500 largest companies listed on them, including all 7 of the Magnificent 7. And then of course there's the NASDAQ. NASDAQ is primarily for technology stocks. It lists technology offerings. At the end of 2024, the value was $32 trillion, or 50% of the overall stock market. So now that we understand what the stock market is, it's really, you've got the NASDAQ stock exchange, you've got the Chicago stock exchange, you've got the Pacific stock exchange, and then New York is the most famous one, and then you've got indices that run off all the stocks that are out there, and they try to track the market. Performed in recent times. If you look at them over the past 30 years, and I chose 30 years intentionally because it's a good period of time to think about a long-term investment. You'll see that the S&P 500, which is the most widely followed, and what most investment managers and hedge funds track their performance against, has averaged over the past 30 years 8.5%. The NASDAQ, which is technology weighted, the more technology driven, by the way, you've seen it has more highs than all the others in the one in orange, but it also has more lows than all the others. It varies very widely because technology stocks are very volatile. It has the highest return on average over the past 30 years, almost 11%, 10.9. The Dow Jones has the lowest because these companies tend to be larger and more established. They're not growth companies anymore. So growth stocks are primarily going to be in the NASDAQ. These are what we call blue chip. They've grown enough already, so their upside growth potential is much lower. So they'll average 8.1%. And so you see over the past 30 years, this is how they have performed each year. Steady as she goes is the S&P. So as we established before, the odds of beating the market in any year, approximately 50%. Over 30 years, forget about it. Which is another reason why, and I'll say this and then I'll say this and then I'll contradict myself intentionally. There are many investors, investment managers out there, think hedge funds. There are many hedge funds that promise phenomenal returns. The Bernie Madoffs of this world, I'm sorry, let me not even go there, right? But there are many hedge funds that promise phenomenal returns over time, and then they charge exorbitant fees. The typical hedge fund, by the way, they charge 20% on their annual earnings. So whatever returns they generate, they take 20% of that, and then they charge you 2% of the total assets that they manage on your behalf, right? So that's a very, very hefty fee. But over time, very, very few of them actually beat the stock market. So it actually is a bad investment to invest your money with a hedge fund. There are very few who will do better than the market. I'll point to one, but most will not, just by nature of how the market operates and the risk that they take in particular. But there is one, and I'm going to point to him, and he's not a hedge fund anymore, but he ran one years ago before it was called hedge fund. His name is Warren Buffett. Over the past 30 years, his company, so I chose 1994 and I went back 30 years before, the prior 30 years before that, Warren Buffett was operating as an investor, very similar to a hedge fund manager, even though he bought Berkshire Hathaway. And that prior 30 years, they did it phenomenally well. But over the past 30 years, they've only beaten the market 20 out of the 30 years. So they haven't beaten it every year, just 20 out of the 30 years. Nevertheless, over those 30 years, his returns has beaten every indices in the stock market. 12.8% compared to the NASDAQ at almost 11, the S&P at 8.5, and the Dow Jones at 8.1. So this establishes the fact that it is possible, and I chose one example. There are a few others I could choose in terms of how effective they are. He's an active money manager, I should say money manager, an active investor. And he uses the principle of value investing, and I'll speak to value investing. In other words, how does he do it? The two main schools of investment, he is one, and I'll speak to both, him and the other. His philosophy works as proven by here. Now, let's put this 12.8% in context. Compare the 12.8 to the 8.5. Say you had invested $100,000 in Warren Buffett's company at the beginning of 1994. How would you have feared? Well, believe it or not, that incremental difference of 4.3% between what his company did and what the S&P 500, which is the established market benchmark, did, you would have earned an additional $2.9 million on your investment just by putting $100,000 in his stock versus the overall S&P 500. So a question is answered, can you beat the market? The answer is yes. But it takes a particular skill set to try to accomplish that, yes. He did it by applying this principle. It's called value investing. He is the most famous disciple of the principle of value investing. He learned it from his professor, Benjamin Graham, who was a professor at Columbia University. And he and his colleague called Graham Dodd, they wrote a book, Graham and Dodd, established the principle of value investing, which I'll talk to you in a second. And Warren Buffett became their most famous disciple. And he learned it by, actually not by going to Columbia, he knew about it a little before. He went to Columbia because Graham was there and he wanted to learn more from him. Value investing is based on the principles of fundamental analysis. What is fundamental analysis? Fundamental analysis tries to find we're going to use a term here, technical term, the intrinsic value of a company. This means we want to find, and watch my fingers now in hyphenated quotes, the true value of a company. The true value really is not observed. We don't know what the true value of a company is. But we try to estimate it using these financial tools to help us to get us to intrinsic value. And how fundamental analysis is applied, it tries to take the company's financial statements, look at its financial performance, tries to look at the industries it operates in, who its main competitors are, and estimate what its true long-term price should be by discounting the cash flows back to the present time. That's a mouthful. Did you all get that? But what does this mean in principle? It means this. If after you've done your analysis on a particular company and you think that that company's true value is $20 per share, if that stock out there is trading for $25 a share, then that's not a good investment. It means it's overvalued relative to what its true or intrinsic value is. But if after you've done the analysis on another company, going through everything, and I mean everything, it means looking at the sales or the revenue of the company, forecasting the cost of the company, looking at its management board, how strong management is, what are their strategic priorities, their goals, looking at the political landscape, will we have what fiscal policy will look like, what will the effects of tariff policy be on the company, what will the Fed do, what is likely to be, all those things, and you put it all in. If after you've done that analysis, you say, boy, stock A, I think is worth $30 a share, discounted that cash flow back to the present, but it's currently only selling for $20, now that is a good investment. And so Warren Buffett, through his business partner, who was vice chair of Berkshire Hathaway, his name was Charlie Munger, died last year at the age of 99. So you can see these young fellas who are running Berkshire Hathaway. His philosophy to Warren Buffett was this. Warren Buffett embraced it. He says, you buy great companies at a fair or reasonable price. So if you see a company with good long-term solid potential, and this is the most important part, have very good management that can replicate the performance year after year, and you can get it at a reasonable price, cheaper than what you think its true or intrinsic value is, you buy that company and you hang on to it for a long time. So if you can get a $30 company at $20, you buy it. That's the principle of value investing. Now, it's a lot easier to put on a slide than to analyze. It takes a lot of work. Value investing is long-term investing. You look for great investments over time, and then you buy those stocks and hold on to them, which is what Buffett did when he bought Apple stock in the early years. He just sold a chunk of it in Q4 last year and made a significant amount of money. He bought Coca-Cola as another of his value investments and did particularly well with them, right? Because you spend a lot of time trying to figure out where great investment opportunities However, there is a difference, another school of thought on investment. It's called trend investment. And so I'll speak to the difference between value investing and trend investing. So the large investment firms on Wall Street do not apply value investment, and they do phenomenally well as well. How do they do it? So they're called prop trading. Prop is short for proprietary trading. So proprietary trading, proprietary just means I'm using my own capital, not borrowed money. Well, you can use some borrowed money as well, but proprietary trading is more trend analysis. They use charts to determine when a stock is moving higher or lower, and they try to do momentum trading. So they trade it on the way up and they trade it on the way down. Momentum trading. Most Wall Street firms use this methodology of trend analysis. Most day traders use trend analysis, and there are a lot of investors out there that are phenomenally successful doing trend investment. In fact, Warren Buffett said a few years back, he was very skeptical of trend or momentum trading. And recently he came out and said, apparently, this is his words, apparently both ways can be successful at making money. So he finally conceded that trend analysis can also succeed in making money. It's not his style, but he's not questioning folks who do. So what is trend investing? I'm not going to get into the details of chart reading. It's very, very technical. But it requires looking at moving averages, looking at the charts, identifying the swings in particular stocks, when markets oscillate up and down, identifying when key economic variables might occur that will move the market. An example would be if the Fed raises interest rates or cuts interest rate, how will that impact the market and therefore a particular stock? So it's momentum, so trend investing is very short term. Value investing is very long term. And so the difference between them is fundamental analysis goes with the company, the industry, the macroeconomic, and then tries to determine future profit outlook. This one looks at what's going on right now, where is it likely to go, how do we move with the market as the market moves. Now, as you can guess, this is more of a guess, trend analysis. It means sometimes you'll get it right, sometimes you'll get it wrong. The track record with trend investing is that if you are right 50% of the time, that's great. You can even be right less than 50% of the time and still be successful, because what they're looking for is one big return, and that would offset a lot of small losses. That's the typical plan. But again, this is really for the technical experts, particularly those prop trading firms on Wall Street. The average investor is not going to be successful doing this because you don't have the time to watch the market every second of the day and operate off trends. So before I move on to the question of whether the market's overvalued or not, are there any questions on trend versus value investing?
Are you talking about computer trading when you talk about the trend trading?
Yes, and flash trading, all of those which are really just all they're doing is anticipating where they think the market is going and trying to get ahead of the market. And oftentimes they're looking to make very short, very small returns. Think about it this way. Imagine if you could make a 1% profit in a day. Just in a day. There are 250 trading days in a year, as there are 250 work days in a year, right? 5 work days a week times 50. If you can make a 1% profit in a day and do that 250 times, you're going to be very successful. Obviously, very few people are able to execute that on a consistent basis, but that's the methodology these guys go with. Try to do a very quick analysis, make a profit, get out, and then replicate it again the next day.
As a group, do the people who do trend analysis do better or worse than the people as a group who do technical analysis? Or
I know your question. It's a great question. I don't see a lot of data to answer that question accurately as to which is better. I will tell you, most of the trend analysis is in the Wall Street group, or most Wall Street investing is in the trend analysis. That's the better way of saying it. When this group does well, they do phenomenally well. Just recently, all the big investment banks reported their financial earnings. JP Morgan, Citibank, Wells Fargo, all of them. And every single one beat their estimates in the stock market because all of them did better in trading in the fourth quarter than had been anticipated. But there was a very specific reason for that. I don't want to get into that, but it all occurred after November 5th. Yes, it was that, what they call it, the Trump trade. And so the market became an upside swing. But this group, as a group, did terrible during the financial crisis. They actually lost a lot of money during the financial crisis. Of course, you and I bailed them out, but that's a whole different conversation, right? But that's the point, right? They do well when the market's doing well. They do terrible when the market's doing terrible. The value investors almost are the opposite. When the market's doing well, they're underperforming the market most of the time. Because the trendy stocks are what are moving the market. I'll show you in a few slides how the Magnificent Seven perform, right? Those are the trendy stocks. But when the market's doing poorly, their value investing stocks are slow and steady. You remember the story about the hedgehog and the hare from grade school, way back when, remember the story? So the hedgehog, we have tortoise and hare. The tortoise and the hare, that's what I don't know why I said hedgehog, the tortoise and the hare, sorry. And so the tortoise is slow and steady, and the tortoise wins the race. And that's the concept of value investing. Slow and steady wins the race. If you know when to get out, trend investing is good. But that's the big if. Not many people know when to take your winnings and leave. It's like playing poker, right? And when you're up, how many people know when to take your winnings and leave the table? And so that's the fundamental problem. But yeah, there aren't a lot of statistics to show, but I'll show you an even better way between trend and fundamental investing in a second. What everything here points to is that if you try to mimic the market just by investing in a market index, you're actually better off in the long term. Because then you have no need to figure out which one or the other. There are not hedge funds, but mutual funds that do value invest in mutual funds. I've not looked at them to see how well they've performed recently. And there are some that do trend analysis, but most of them, the significant majority of them, just track the market, the broad indices. That's the best way to do it. So let's answer this question. Okay? Time now, looking at whether the market is overvalued or not. I get that question a lot. This is what the stock market's performance has looked like over the past 75 years, since 1950. This is in current value terms, so not adjusted for inflation. So over the past, you can't even see what the numbers are in 50s, 60s, 70s, and 80s, right? It just skyrocketed. Now, the way to properly answer the question of what do the trends look like is you've got to normalize a lot of things. And so I use this company, I like this company, it's called Current Market Valuation, right? It's a subscription and I subscribe to it. I'm not endorsing them. Just as I'm not endorsing Berkshire Hathaway and Warren Buffett, right? I mean, you invest in those companies at your own risk, again, that's my disclaimer. But one way to track the market to determine whether it's overvalued or not is to normalize it and then trend it. And so what do we mean by normalizing it? So if the stocks in 1950s, 60s, and 70s were in 1950s, 60s, and 70s dollars. those dollars are different from dollars in 2024. What do we mean by that? It means that a dollar that you earn in 2024 does not have the same spending power as that same dollar in 1950. There's some of you who are shaking your head, you're like, hey, I remember when I could buy a house for $20,000. I'm tough, those days are gone, right? But if I were to normalize, in other words, take a 1950, 60, or 70, and then convert it to 2024 dollars, right? So reframe it in 2024 dollars, this is what the stock market would have looked like by putting the earlier years in 2024 dollar terms. And then the next way we do it is we exponentially trend it. Why do we do exponential trending versus straight line trending? Because the market's returns compound on each other, right? So 1% compounds the next year, it's not going to be 2%, it will be 2.1%. And then 3.2, it compounds. So because you're compounded not the principal, but the principal and the interest. Does that make sense? And so to do a trend analysis, you've got to do an exponential one to take into account the compounding effect. So if we did that, the stock market's value in 2024 should have been, notice the word should, right? I'm getting into a normative statement here, no, not a positive one. Should have been 73% lower than it is today. Said another way, the stock market at the end of 2024, and I used the January 3rd, 25, that was a Friday, and this is when they published these data on a Friday. It's 73% higher than what its true long-term trend should have been, which is somewhere around the mid-3000s. So that's the first question we ask ourselves. And we can look at this through a multiple lenses. I'm going to show you them in a little bit, right, in more detail. You can see that we had one peak in the market around the year 2000. Who recall what event occurred around the year 2000? The dot-com bubble. We're not talking 9/11 now. That was a non-financial event. The financial event was the bursting of the dot-com bubble, right? So during the mid-90s, we had all these technology stocks, internet-based stocks, that were just skyrocketing. And then on March of 2000, the bubble started to burst. And it had multiple bursts, right? It was a big balloon. And then it crashed, and then what we had was another run-up. This one prior to the what? The Great Recession that they call it, right? So the Great Financial Crisis, we had the subprime mortgage effect, the market got ahead of itself again, and then that effect, the collapse of that caused this. This had a very particular event, right? And that was when we had a number of companies beginning with Countrywide Financial and a few others that started to collapse. So there was an actual event that precipitated this. There was no actual event that precipitated this. The market just got ahead of itself, and then and many people might have recalled Alan Greenspan's great comment in 1996, somewhere around here. Irrational exuberance. He said the market just get irrationally exuberant, and the market just started to correct itself. Again, there was no external factor that precipitated it. But then we had another event. So we had the financial crisis. Then we just started to have another, it just kept going up, right? There were some moments where it went down and up, but it just kept all the way up.
Be prepared.
What was this? By the way, this one was the crash of related to the COVID, right, in 2020. But what precipitated this at the end of 2021? This was the COVID bubble. So it turned out the economy, the government had spent so much money in the economy. That was one. The second thing was consumers who were at home not spending money. The moment they were able to get out and start spending money, that was a pent-up demand in the economy. And that was what unleashed the inflation of 2022, right? But it was the rise in the stock market of 2021, pent-up government spending, pent-up consumer demand, that was unleashed from 2020. All of that just flooded the market at the same time, and it led to a huge run-up in stock at the end of 2021 that had a subsequent huge correction in 2022. But of course we didn't learn our lessons, so we're having another major run-up again in 2023 and 2024. And so the question is, how long will this last? That's the question. So if we do a trend analysis, we can see the market is way ahead of where its trended return should be. So I'm going to show you 4 different analyses to answer this question, and then let you come to your own conclusion. But this is analysis number 1. Stock investing, price to earnings ratio still remains the number 1 method to use to value stocks as to whether they're overvalued or not. So how do we get price to earnings? We look at the actual price of the stock and divide it by the earnings of the stock. That's we call it price to earnings ratio. What's a good number? It's going to vary. Again, I'm an economist, I'll always tell you that. But there are some objective metrics that we can look at. So you'll notice we're looking at what we call the 10-year price to earnings ratio. So let's talk about this because it's a very important metric. It's the most widely used metric to value, to ascertain whether a stock is overvalued or not. Traditionally, we use what we call trailing 12 months price to earnings ratio, or historic price to earnings ratio. But there's a problem with using the historic price to earnings ratio because we're trying to determine if the P, or price, is too high or overvalued. So it means we have to use an E, or earnings, that is appropriate. But what do we mean by appropriate? Right? Now we get into another normalized term. What does appropriate mean? It turns out in any given year, a company's earnings goes up and down, just like its price. The earnings can fluctuate. A company can have a good year, the economy can do well, and likewise a company can have a bad year, the economy can do badly, right? So a lot of things can affect the earnings of a company. So if we look purely at a historic price to earnings ratio, we may not always get a good measure of whether or not that's a fair value. The number, if the earnings is low in a particular year, and I'm trying not to get into the math, but if the earnings falls, then the price to earnings can go artificially high, but it doesn't necessarily mean that the company is a bad investment because the PE is too high. It just means that the earnings that year was too low, and the earnings might pick up the next year. Conversely, a company might have a very good year for different reasons. I'll pick Nvidia as an example. I'm picking on them, don't sue me. Nvidia is doing phenomenally well now. Now their earnings are projected to also do well, but the price has gone way higher than the earnings could ever justify. So their price to earnings right now is phenomenal. It was about 100 something, I think it's down to 50 or something right now, but it's still relatively high. So it's hard to get a gauge on historic price to earnings because we don't know what the true earnings should be. What many investors these days are looking at is what we call forward earnings. So what's the earnings the next year? Next year's earnings. Now, I'm going to go on record as saying I don't trust those estimates because they're based on assumptions that are very wild, often overly optimistic, and most of the time does not make sense. You remember when we talked about fundamental analysis, how fundamental analysis is performed? Fundamental analysis looks at forecasting the revenue of the company, forecasting the cost of the company, measuring its cost, looking at how you have to look at management's goals and objectives and their strategy when you try to determine earnings. Most of the time, we'll never know all the details about a company's revenue prospects, cost forecast, what management thinks, and less we will know trends and developments in the industry or the macroeconomy. How will Trump's tariff policies affect the economy? Economists are divided on that. We don't really know. So those will affect the forward earnings of a company because we don't know what the macroeconomy is going to look like. So as much as it's a good idea to try to estimate forward earnings when we do price to earnings, it's nothing more than an educated guess. So an economist named Robert Shiller, a Yale economist, won the Nobel Prize incidentally a few years ago. For those of you who follow the housing market, he created some housing index. he came up with a concept that looks at 10 years average earnings. He called it CAPE, meaning cyclically adjusted price to earnings. So if you take the 10-year average earnings, you eliminate the highs and the lows in the earnings for that period of time. And you get what he calls a normalized earnings. So when you do a 10-year average or normalized earnings, now you get a much better idea if a stock is too high or too low by looking at its price, current price, relative to that normalized 10-year earnings. That make sense? And many economists find that to be a much better way of measuring the true stock's value or worth using its normalized earnings. So the 10-year price to earnings ratio. Now we're going to put another concept in here. Again, go back to your high school and college statistics. I know it was traumatic, but just try to get back. And we're going to talk about standard deviation. Fun times, right? So to really understand whether something is overvalued, we look at it in standard deviation terms, around the mean. So the mean of the historic price to earnings ratio, the mean of 0, we're going to call it that. And if we have a standard deviation of 1 standard deviation above the mean, then we say the definition is we believe that market overall or the individual stock is overvalued. But if it goes 2 standard deviation above the mean, now we're talking about an extreme outlier. That's when we talk, and if we go 3 standard deviations, that is an absolute, it's a very, very unlikely event. That's a 3 standard deviation. But 2 standard deviation is typically what we look at to determine in this case, if it's 2 standard deviations above the mean, then we believe we call this overvalued. And so if we look now at the stock market, and I'm putting it logarithmic terms so we can see better. So if you recall the last chart where we had it trending up, now we're just putting it flat because it shows better. Here's what we see. There were only 3 times since 1950 when the stock market actually hit what was called this strongly overvalued territory. The first was during the dot-com bubble, and it actually went so far as 3 standard deviations before we all know what happened. It collapsed back down and went back to almost its historic norm. The second time was at we call it the COVID bubble at the end of 21. It again went over 2, went 2.2, 2.3, and then came crashing back down in 2022, end of 2022, went back down into what we call fair value territory, and now it's doing another run up. And at the end of 2024, it's about 2 or a little over 2 standard deviation, about 2.1 standard deviations above its historic norm. So again, using the 10-year CAPE price to earnings ratio, we are seeing that the stock market again, measured by the S&P 500, is in rarefied overvalued territory. That's the second way of looking at the market. The third way, and I'll quickly wrap up, I want to leave time for any questions you may have, is just looking at the actual value of the PE ratio. It's currently at a ratio of 37, price to earnings. Now what does price to earnings mean? What does a price to earnings of 37 mean? It means if a company's earning a certain amount and its PE is 37, it will take 37 years. If the company keeps its earnings at the same rate, it will take 37 years for the earnings to actually match the current price. 37 years. Now remember, what a company earns is not all that goes to shareholders. What the shareholders get is what's called dividends, right? We typically value a stock in terms of cash flow. But what we look at is earnings drive cash flow, and cash flow determines dividends. So if it takes 37 years just for the earnings to get back to what the current price is, it will take even longer for the dividend payments to get to the investor. In this scenario, over the past 70 years, the historic average of the price to earnings ratio is little over 20. Now, many, many years ago, that number used to be 15. Then I remember when the average was 18. Now the average is 20. The average has been pulled up because of the market has been performing very high over the past few years. So the average now is at 20, but it's still very high. But however we can look at this, what do we conclude? We can conclude that if the average of the price to earnings should be 20, the price should not be more than 20 times the earnings on average. If it's currently 37 times the earnings, that means the current stock market price is almost double what its historic norm should be. That's another way of looking at it, right? Just based again on looking at the trends where the 3 times it's ever gone above, say, 35 have been in 2000, the dot-com bubble, 2001, the COVID bubble, and now 2024, 2001 and 2021, and 23-24, this is the Gen AI bubble that's being driven primarily by NVIDIA, right? So it's Gen AI that has been driving this most recent surge. Market valuation, where is overvalued? This one I'm going to get back to now. It's called a Buffett indicator. I mean, Warren Buffett should be paying me here. I'm really doing him a service, right?
Yeah.
But at the end of 2001, during the height of the dot-com bubble, Warren Buffett came up with this metric, very simple metric. He looked at the total value of all stocks in the economy. It's called market capitalization. And he divided that by the GDP. In fact, he divided it by the GNP. But again, that's a technical stuff. Don't want to get into that. But most economists now look at it in terms of the GDP. They're relatively similar in the US, so we're not missing anything. And what his metric asked was, how do we benchmark the value of the stock market relative to the size of the economy? Because the value of all stocks in the stock market shouldn't be much higher than the value of the overall economy, right? Just think about the logic of it for a second. When you look at a stock of a company, we measure the value of a stock in terms of its discounted cash flow, discounted to the present. So what we look at is, what's the company's earnings potential? And from that earnings, what is the cash flow, or what we call, technical term, free cash flow coming from those earnings? And then can we discount that back to the present time to get to a fair or intrinsic value of the company? That's how most financial analysts look at it. Think about it. Every company operating in the economy, if we discount back their earnings and their free cash flow, should those companies' total value exceed that of the US economy? Probably should not. Although we are talking two different things. We're talking a stock versus a flow. I admit, I understand that, right? So if we get into a technical thing, one's a stock, one's a flow. But look at the history of the US investment economy, right? Since 1950. Admittedly, we don't have this during the 1920s when we had the great crash of 1929. Maybe things were different then. I don't have the data on that. But if you look at it, even during the dot-com bubble, the highest stocks ever reached as a percentage of the US economy was 1.5 times. That was the height of the dot-com bubble in 2000, 1.5 times. Now, we're at a point, the post-COVID bubble, we were a little over 2.05, and now during the Gen AI bubble, we're actually at 2.1 times the size of the US economy. This was something Warren Buffett came up with to ask the question, how do we know the market as a whole is overvalued? We call it a Buffett indicator. And as you can see, at 213% or 2.1 times the size of the US economy, it's the highest it has ever been in our recorded financial history. if you trend this metric, then you could see that we are currently 68% higher than what the true long-term trend should be. Again, this should is a statistical analysis, but it just points to the fact that looking at all four metrics, probably not a gross exaggeration to say the stock market currently appears to be overvalued. In which case it might be due for a correction similar to what we saw after 2000, where the ingredients are very similar to what we have today, or after 2021, when this was just pent-up demand being released in the economy. Why is it currently in an overvalued state? Well, since 2023, the beginning of 2023, 7 stocks have really driven about 58% of the total S&P 500 returns. 7 stocks. They are called the Magnificent 7 stocks. Let's look at their performance over the last 2 years. In 2023, the market as a whole grew 24.2%. In 2024, it grew 23.3%. But each of these stocks did phenomenally better than the overall market in 2023. Only one of them performed less than the market in 2024. If you were to take these 7 stocks out of the S&P 500 and then just look at the other 493, the S&P 500 would have only gained 9.2% in 2023 if these 7 stocks were not in there, and it would have only gained 10.8% in 2024, again if we took these stocks out. So these 7 stocks alone are driving this phenomenal return in the stock market. One more bit of information. The S&P grew over 20% in back-to-back years for the first time since, take a guess.
Dot-com bubble?
Since the dot-com bubble in 1999. That was the last time the S&P 500 had 2 successive years of 20+% return. So do with that whatever you will in terms of what to make sense of it. A couple of things I want to point out though, quite interestingly, if you take a look at it, how has each stock performed in 2024 relative to 2023? Each stock, how have they performed?
Less.
You're all trending down. You see that? Even the great NVIDIA, you're all trending down in 2024 relative to 2023. And so, it's interesting to see where the trend in 2025 is heading, and ultimately what the impact on the overall stock market is likely to be like. So, in summary, we can say we looked at 4 metrics on the US stock market as measured by the S&P 500, and it clearly trends to a very overvalued market. So really, there are 2 questions to answer. I'm sure you're thinking about them, so I'll think about them for you. How long will this overvaluation last, and what should you do about it? So let's talk about the first one. How long should the overvaluation last? There's a great economist by the name of John Maynard Keynes. You may have heard of him. Great British economist. But this was not in his economist role. He used to also be the investment manager for the funds at, I believe it was Cambridge University. And as the investment manager for the funds at Cambridge University, as you think of every college nowadays has an endowment fund. So he managed Cambridge Endowment Fund. I believe it was Cambridge. If I'm not, I'll get that right. But I believe it was Cambridge. And he had this great quote way back in the 1920s, almost over 100 years ago. He said, markets can remain irrational longer than investors can remain solvent. By saying, consult your financial advisor, right? I'm not giving any free advice. This is just generic information. So let's say you have investments, you earn company stocks as a part of your compensation. If you get company stock, you never want to be over invested in one investment. There are many people who had investments in Arthur Andersen and in Enron. All of their retirement funds were in that, and when those companies crashed, they lost everything. So you always want to diversify. But what if you don't want to diversify? Well, it turns out there are many families whose companies started large corporations that are still around today, right? Think the Rockefellers and the Fords and all the other, and the Carnegies. Those families still have a lot of stock in one particular company. So how do they protect their investments? Well, they use options to protect their investments if they still want to keep those things. So my suggestion to you is this: there are only three ways to protect your investment in this day and age. You can do what Warren Buffett did last November. He sold most of his Apple stock and then just took the money and bought treasury bonds. They're paying 4 to 5% right now. So it's not like you're getting nothing. But he saw the writing on the wall and said, you know what, I'm taking all my profits off the table, selling all my investments, most of them anyway, and then I'm gonna put it in cash and wait for the market to correct itself, then I'll go back in. That's what a lot of investors do. So you can shift to cash and then buy treasury bonds and just sit and wait. Or you can short select stocks. Now, shorting a stock is very technical. You can also lose a lot of money. So I'm not gonna get into too much details on that. But if you don't even want to short a stock, say you want to short Nvidia, you just buy it, sell it short. Again, I'm not gonna get into the details of it. Those who are technically savvy know what I'm talking about. You can also short the overall market. You can short the S&P 500. How do you short it? There are ETFs out there that short the S&P 500, so you just buy ETFs that short the market. And just say, hey, eventually it might correct itself. Maybe 10% correction, maybe 20% correction. But when it does, a short ETF actually rises in value because it's a short. And the third way is just buy options. There are three ways to buy options, right? I'm sorry, there are multiple ways to buy options. That's just the third approach. Again, option investing is very complicated. I'm just giving you the broad categories, and if anyone has specific information, I'm happy to talk to you offline. But just to say you own a stock and you don't want to sell the stock because you like the company very long term. Well, the way you protect yourself is you can sell a call on that option. A call option on that stock. That's what most professionals do. I personally don't like that approach because your downside risks are unlimited. When you sell a call, your downside risks are unprotected. So I don't like it, but most professionals like it because they get the cash. By the way, I'll tell you this, a little secret. Most options, 80% of all options expire on exercise. So if you sell an option, there's an 80% probability you get to keep all the money. The problem is there's a 20% probability of unlimited downside risks, right? So that's the reason why I have sold short calls in the past.
What is a call?
A call option is the right to buy a stock, but not an obligation. So I buy a call option on, again, let's pick Nvidia. Nvidia is currently what? $150, I think?
137.
Yeah, it went to 150 a couple days ago and then probably came back now. So say you want to buy it and it's currently 137. But you're afraid in another 6 or so months it might even go up. So you buy a call option, the right to buy it at 130 or 120 or whatever the price you pick. And then if it goes up much beyond that, you still have the right to buy it at the lower price that you selected. The problem is it can also go down. So if I buy an option at $130 and it drops to $100, that call option now is now worthless. Because I would never exercise it at $130 when I can buy it at $100 in the open market, right? So the option is just, a call option is the right to buy the stock at a predetermined price. A put option is the opposite. It's the right to sell that same stock at a predetermined price. And you will buy a put option if you believe in the near term the stock is going to increase. It's going to decrease. So if you think the stock is going to decrease, you buy a put that says, I have the right to sell it at a predetermined price. Again, let's take Nvidia. I could buy the put option if I own Nvidia at the right to sell it at $150. So even if it drops to $100, it doesn't matter to me, I still get to sell it at $150. That's what I put up. It's like an insurance policy. That's really what it's like. But it's a risk because the price can continue to go up. If you buy it at $150, put option and it goes up, then your option is worth less. But you still get to sell it at a higher price, so you don't really lose much. And that's what a protective put does. Again, if I own the stock, I buy the put that gives me the right to sell it at a predetermined price. So if the price goes up above that, I still don't lose. I will lose just the amount I bought the put for. But outside of that, I would be better off with a stock, which is most of what my investments. I use protective puts, what they call them merit puts. And there are other options. I'm not going to get into it with the interest of time. You know, protective calls, straddles, and long straddles. So those are different options you can apply to protect long-term investments if you own a stock and you don't want to sell it. How do you beat the market in the long run? My suggestion, buy market tracking ETFs. Buy ETFs tied to the S&P 500 or the NASDAQ. And then I put beat in quotes because you will not beat the market in this case. You will just mirror the market. Whatever the market does in 30 years, you will do exactly the same. And if you buy a no loads ETF or no loads mutual fund, it means no fees, then you don't have to pay any fees. So your return is going to be almost exactly the same as that. And so I advise people, this is what I told my sons, right? Just graduated college in their 20s. I said, look, the first thing I want you to do is take a minimum of $2,000 a year, more if you can, if you're in your 20s, and just put $2,000 a year in an IRA for the next 10 years. That $2,000, you'd have spent it anyway doing stuff you'll never remember, and you'll never see any value of, so just put it in somewhere, invest it, and forget it. If you were to put $2,000 a year or 10 years in an IRA, then that $20,000 is going to grow to somewhere between $165,000 and $294,000 in 30 years. What I told my sons is, your 30-year-old self will thank you for making that sound investment. In fact, I go so far as to say, whatever age you are at, you can make long-term investments that will still pay off, right? Currently, the latest actuarial studies tells us that most of us will live into our late 80s to early 90s, especially if we exercise regularly, don't smoke. I'm giving you some health tips here, or just do moderately drink alcohol, right? So those will likely, you should live well into your 80s or 90s. So wherever age you are at, there you should be able to maximize some investment that will see a payoff in 20 to 30 years. And so the advice I give folks is either maximize your 401k if you have one at work, or invest in an IRA. I think the current limit is $7,500 you can put a year, $8,000 if you're over 50. And if you maximize that, you will see phenomenal payoffs in the next 20 to 30 years. Again, all of this I'm going to caveat by saying there are income limits to invest in an IRA. So talk to a financial advisor or a tax professional, because some of these things you may not be able to participate in if you earn too much money. And so with that,